So Nicholas Bornos of Capital Link, I'd like to welcome you to this session, another session in our forum today. This session is focusing on a particularly interesting topic. The closed-end fund, the IPO market has been going through a period of strength. So we have a great group of panelists who will take us through the market dynamics. I'd like to thank Dave, Finbar, and Stephen very much for their participation. And of course, Jefferey LeMaster from Clifford, who is going to be our moderator. So Jeffery, I'm turning the floor to you, and thank you to all of you for joining.
Well, thank you so much, Nicholas. And everyone, thank you, as Nicholas said, for joining our session this afternoon. I know I can speak on behalf of the rest of the panelists to say we would have preferred to have been in person. But we're always hopeful for next year. I just pray that we don't have to say that next year. So maybe without further ado, I can introduce our esteemed panelist here. So Dave Lamb is Senior Managing Director and Head of Closed-End Funds at Nuveen. There's Stephen Minar, Director at BlackRock, and Finbar Ward, a Vice President at Morgan Stanley Wealth Management. And maybe before I launch into questions of our esteemed panelists, maybe I'll set the stage for just a moment around where we are kind of in the closed-end fund market and what we'll call CEF 2.0 land, which I think we all generally agree began the beginning of 2019. There was 25 closed-end funds or approximately 25 that have been brought to market since the beginning of 2019. And I think just to give you a sense of what some of the recent raises are, I'm going to run through the dollar amounts that have been raised in 2021. This assumes the exercise of the overallotment in full. 2.23 billion, 506 million, 4.9 billion. I mean, that number is astronomical. 661 million, 1.71 billion, 1.13 billion, 667 million, and 2.33 billion. I've been doing this for about 15 years. I can tell you that is more billions that I have seen on probably all the deals combined, much less than a single year. So clearly a very impressive run for closed-end funds as of late. So Finbar, maybe turning to you first, from just an overarching perspective, what are the terms that you're generally seeing in the market these days associated with what we'll call CEF 2.0 land?
Hi, Jeff, and thanks to you and everyone at Capital Link for having me today. So let's see, I started in the closed-end fund business in 2016, I recall, and the structure back then was a 5 to 7 year target term structure with a client-paid sales load. And fast forward to today, the structure has evolved into generally a 12-year term structure with the issuer paying not just the sales load, but all upfront expenses. And as a result of, I guess, the attractiveness of that proposition to investors, what we have seen here at Morgan Stanley is we have seen an increased participation rate amongst our advisors with each and every new issue that comes to market. And that's reflected in the numbers that you outlined at the start. And the reason that is that every issuer that comes to market with a new closed-end fund, they leverage their relationships to introduce FAs to the new structure and educate them on the benefits of it. And in particular, what we've noticed, especially over the course of this year, is amongst our financial advisors, we've noticed an increase in participation amongst our private wealth advisors.
Oh, thanks for that, Finbar. And I guess maybe other than the new terms that we're seeing in the closed-end fund market, what other differences are you generally seeing of the closed-end funds of today versus what we would have seen, call it 5-10 years ago?
So I'll go back to 2016 again, Jeff. And back then, most of the product, at least most of the product that I worked with, was fixed income. And even within that, I think 70% of the underlying was high yield corporate credit. And today, while closed-end funds are primarily used by our advisors for income, or by investors or their clients, the underlying use to achieve that varies. Some funds have allocations to equity securities, for example. Some use fixed income securities, and some a combination of both. But in general, there are also other, other innovative terms, if you will, that are used within the structure to achieve the objectives. So some funds have a dedicated private sleeve, allowing investors access to illiquid securities that they otherwise may not get access to in a product with daily liquidity. Some funds continue to use leverage, some do not. And more often than not, we see funds use an options overlay strategy to generate income and enhance returns. And what all this has led to is a more differentiated set of products that we had in the past. And it gives investors access to themes or sectors that they may not have had access to under the old structure.
Yeah, I mean, obviously we're kind of seeing the same. And I think follow on to that, Dave, obviously Finbar brought up the idea of differentiated strategies, the new terms that we're seeing in the closed-end market more generally. And how have you, though, seen that translate in terms of the closed-end fund investor base at Nuveen?
Well, thanks, Jeff, and really appreciate the opportunity to be here. To put it into context, I think Finbar mentioned he's joined the Morgan Stanley in 2016. I just celebrated my 30th year at Nuveen, so I've seen the transformation of not only Nuveen's business, but the closed-end fund space. And that touches upon the evolution, what I'm seeing in how investors are using closed-end funds. Historically, we've seen, closed-end fund investors typically being, older investors that are near or in retirement. They're seeking attractive levels of regular income, which oftentimes may replace a paycheck, that a shareholder no longer receives. I think that still is the dominant focus of investors, but as Finbar mentioned, the new differentiated strategies may have access plays, democratizing access to privates, for example, for as low as a $2,000 investment. So I think we are, in addition to seeing new advisors come into the space, I think we are seeing still an evolution in investors coming into closed-end funds for things other than just income, maybe total return, and utilizing some of the differentiated strategies to gain access. So that's what we're seeing today, and I think it's going to continue in the future.
I think I had heard at a different conference, maybe even a year or two ago, that the closed-end fund investor base was made up by 50% new investors versus what we would have seen a decade ago. I think that's really a credit to what this new structure and differentiated strategies provide for. I think to your point, Dave.
Absolutely.
So I think, Stephen, obviously BlackRock, while you may not have been in the closed-end fund business for the last 30 years like Dave, BlackRock has been. I think I just discovered as part of the prep for this panel that BlackRock was actually started as a closed-end fund back in 1988. So for all of us, there's still a chance for us to create a new BlackRock by starting a closed-end fund. Don't worry, Stephen, we're not coming after your job anytime soon. But Stephen, what are you seeing as kind of the main advantages of the closed-end fund structure today?
Yeah, thanks, Jeff, and appreciate the time here. What we've kind of seen over the years is that the closed-end fund structure has been used as as David mentioned, really as an access play. But that term access has really kind of evolved over the years, right? Back in the early 2000s, before I was in this business, there were a lot of country funds that were started because that was a time before ETFs were even a product or a viable product, and so a lot of closed-end funds were launched to provide access to individual countries or regions outside the U.S. And a lot of our existing products and kind of what was built throughout the early 2000s and into 2010s is the access to credit markets and leverage to achieve that income that David mentioned. And what we've seen more recently is that we're now seeing a lot of funds being launched with providing that access to private markets, whether it be equity, debt, or a combination of the two. And I think that's just a natural evolution here, as we've seen a growth in private markets in general. You're seeing a decline in the number of public equities out there, and subsequently a growth in the number of private companies. And so, investors that don't have access to that private market are missing out on significant growth opportunities in the equity markets. Similarly, in the credit markets, what we've seen since the financial crisis is that a lot of banks have kind of stepped away in terms of providing balance sheet, and that's led to that business transferring over to the asset management world. And the benefit of investing in things like private credit is that we have a say in how these deals are structured, and so you get not only the illiquidity premium but also the complexity premium, which can help solve investor challenges for both income and return going forward. I was just taking a look at our capital market assumptions over the next 5 years, and when I look at public equities expected to deliver somewhere in the mid-single digits, compare that to private equity at 20% annualized. Similarly in the private credit side, we're expecting that public credit, to be relatively flat over the next 5 years, whereas in the private credit world, we're forecasting somewhere around 10% annualized returns. So you're getting, again, higher return and also higher income potential by accessing these private markets, and in a really retail-friendly structure, right? Dave mentioned very low minimums. Typical minimum on these products is $2,000 at IPO. You get daily liquidity at the market price, no performance fees, no K1s. This is a 1099 tax reporting, and then you do get that 100% liquidity through that term trust, that limited term trust structure. At the end of that 12-year term. So, again, I think this is only benefiting our client base in terms of providing that access. And every single one of the products that BlackRock's brought to the market over the last few years has had the ability to invest at least 25% of its portfolio in these private credit and private equity investments.
Yeah, and actually, we were just talking before we all came, I guess, on the air, since we're not in person, about potential changes that I guess we all hope may coming down the pike from Congress, with potentially allowing for even greater investment in private funds by closed-end funds. And so it'll be interesting to see if that comes to fruition in what is a maybe less than Wall Street friendly administration right now with the SEC. So, Finbar, one of the aspects of the closed-end fund structure that you mentioned at the outset was the presence of the 12-year term, the limited term structure, which was very different from what would be the closed-end funds of 15 years ago when I started, where there were no terms at all. And then when 2016, when you had started, where it was a 5 to 7, now we're at 12. From your perspective, from an underwriter's perspective, why does the limited term kind of make so much sense?
I think so always and ever when we look at these products that issuers bring to market, we put ourselves in the seat of the financial advisor. And I think practically it makes a lot of sense, right? Their clients get into these products at NAV, they clip a coupon over the 12-year term, and then at the end of the term, they liquidate their shares and get NAV at that point in time. So ultimately, I think, from an investor standpoint, it makes sense. From a financial advisor standpoint, it's certainly something that, they definitely, given all the work that issuers put into educating them, they have everything that they need to educate their clients. And from our standpoint, it just makes it more feasible for us to bring these products to market today.
And Finbar, how have you seen the term structure play out in the secondary market in terms of reducing the discount? Has it been, in your mind, relatively successful in that endeavor?
It's still early days, right? So the first iteration of this new structure was introduced to the market in January of 2019. So we're 2 years and 9 months into this. But to your point, Jeff, I mean, these funds were tested, I guess, during the market-induced volatility last year. And I think if you look at how they performed during and after that time period, I think they've done quite well. In my opinion, just in conversations that I've had with advisors, I think they see an improvement in the trading of these products since the advent of the new structure, and the fact that when these funds go into the secondary market on day one, there's no disconnect between issue price and NAV. So I think that has certainly helped with the secondary market trading dynamics.
Jeff, I might add while I'm not speaking to the new version of the 12-year term structure, Nuveen and others have had term funds that have now approached termination date. And one observation is, as you move closer to that term date, you tend to see the secondary market price trade closer and around the NAV. So certainly on these new 12-year terms, maybe in the initial period of the life of that fund, it may trade on its own and may move up and down with market demand. As you move through the life of the fund, you will start to see that term provision of delivering the NAV that Finbar mentioned come into play, where the price will tend to hug the NAV more closely.
And one more thing to add, sorry, but I think the other element of these offerings in general has been the use of what we consider to be a managed distribution policy. So again, another way to draw demand for these products and help maintain a narrow discount, or even hopefully funds trading at premium. So managed distribution essentially just allows us to pay out different sources of the return, not just only income, but in an equity portfolio, for instance, you can utilize capital appreciation to fund what typically is a monthly distribution rate and generate a higher income or yield relative to what you would get in other investment products. And so that's another tool that asset managers in the closed-end space often utilize to again help manage the discount, deliver a higher income, but also not only just a higher level of income, but also more sustainable, consistent level of income month to month.
No, thank you, gentlemen, for that. And actually, I guess turning both to Stephen, to you and Dave, we heard from Finbar about why the term structure makes so much sense from kind of the underwriter's perspective or the investor's perspective at the IPO stage. But I'd love to get your thoughts on what I'll call kind of the opposite end of the closed-end fund life cycle as it's starting to come, as you said, Dave, closer to the end of the term. So, more specifically, kind of how are our managers thinking about the end of that term? And so maybe, Stephen, a question for you. What are the typical aspects of the end of the limited term that BlackRock is including as part of its current closed-end funds? For example, conversion options, et cetera.
Sure. In the prospectus language, it's considered or termed a contingent conversion feature. And essentially what that means is that in that 12th year of the fund's life, we'll offer what they call a tender offer for 100% of shares outstanding at net asset value. So any shareholders at that time can simply put their shares back to the fund. The fund will repurchase those at NAV. And so clients, again, get that liquidity at NAV. There's a contingency on that. So it differs by deal. In the case of the BlackRock funds, it's been that if at least $200 million would remain in the fund post that tender offer, we would go ahead and proceed with the tender offer, repurchase those shares, and then at that time the fund would continue to trade. And the fund's board could determine, whether or not they want to liquidate at that 12th year or continue as a perpetual fund. Vice versa, if there were to be less than $200 million in the fund post that tender offer, the tender offer would actually be canceled and the fund would just proceed to liquidate at the end of that 12th year. And, I think that in the case of at least our funds at $200 million, again, we just want to make sure that, that these products remain viable post that liquidity event. So we think that anything below $200 million might be less liquid and might not trade that well in the secondary market, and so that's why we've chosen that $200 million level.
Yeah, no, that makes sense. And Dave, I guess just coming to you, from your perspective, is that generally what you're seeing in the market in terms of the end of the term or the contingent feature, or is there any other structures that Nuveen is currently employing as part of its closed-end funds?
Well, certainly the new generation, the 2.0 version since 2019 have generally had those standard features. Stephen mentions the $200 million level. I would note that some sponsors have been silent on that. Some have other minimum levels, but generally that conversion feature is pretty standard for the new products. Now, prior to the 2019 version, certainly Nuveen brought to market and other sponsors funds that had shorter term features, anywhere from 3 to 7 years. We call them target term funds that had portfolio maturity profiles that align with the term dates. Those funds generally had a dual mandate of delivering attractive levels of income with a goal of delivering the original net asset value back to shareholders at term date. So there are other types of term structures out there. I would say in this current environment, and I noted on an earlier panel around the industry roundtable, it was mentioned that underwriters, it's being much more competitive, more selective. There's generally one deal that's targeted a month. Right now in this environment, I wouldn't see the target term funds being part of the mix today. But at some point in the future, as things change, they may come back.
Yeah, I think if someone had told me a decade ago that the sponsors would be paying all of the underwriting commissions, I wouldn't have thought that was going to happen. So you never really, as you said, Dave, know what's going to happen down the road.
Well, and it is an interesting dynamic. It caused a lot of fund sponsors to pause and think about it. You have to then reassess the economics. Does it still make sense? I mean, in the case of BlackRock, in one of their deals, they were writing $180 million check up front, and quite frankly, some fund sponsors probably can't do that. So, it has changed the financial and other considerations up front. Did I get that amount about right, Stephen?
I noticed Stephen is silent right now. He remains on mute.
I had to process that invoices. That was
Well, Dave, both you and Stephen had mentioned kind of the potential conversion to a perpetual fund. What are some of the key aspects that the board at Nuveen is generally considering as it contemplates that potential conversion?
Yeah, and we've had some experience recently with some funds reaching term dates, and in some certain cases we've liquidated funds, and in other cases we've proposed converting the fund and the strategy to a perpetual fund. I would say the board, and I believe other boards, will be focused on clearly what's best for shareholders based on the facts and circumstances for that particular fund as it approaches its term date. I would say boards will likely consider, market demand for the specific fund and its asset class. One clear view of that is how is the fund trading? How are the peers in a similar asset class trading? Is it trading, near par or above par? Now, I would note that if it is a target term, that individual fund likely will be trading close to NAV. So I think it's beneficial to look at, more broad indicators of market demand. So that's one thing. And really along that same line of reasoning, the fund's portfolio may contain investments and yields on those investments that cannot be replaced in the current market environment. So that could be another consideration. And could it be beneficial for that fund to continue on in the future and deliver outsized returns or yields to shareholders? And finally, I think boards also will consider the potential for realization of gains. It goes along the same line of rationale. If an asset class is in demand, you're seeing appreciated assets. If you have to fully liquidate a fund, you may end up delivering a capital gains tax bill to shareholders. So those are some of the, I think, broad considerations, and there's probably others. You would want to ensure that you have, as Stephen mentioned, a minimum scale, of converting a fund to perpetual, and after a tender that you can efficiently run the portfolio that will, have enough liquidity in the secondary market. So there's other additional considerations I believe fund boards will look at the time when they reach the term date.
And actually, Stephen, on that point, obviously, as you get closer, and Dave kind of mentioned it, you're getting closer to the end of the term, you're going to have to consider how you are managing the portfolio itself. And how do you really kind of manage around that 12-year structure from an investment perspective?
Yeah, sure. So, as I mentioned up front, that we do have an element of these portfolios in private and less liquid investments, and so that is a consideration from day one. Typically in a private unregistered vehicle that's pure private equity, what you see in those vehicles is that they once they have an exit, they just simply pay that back to their investors. The beauty of the closed-end fund structure is that when we have exits or liquidity events in our portfolio, we can reinvest that capital back into other private investments or other public equities, or continue to hold the company. And I think actually that's one of the selling points for BlackRock as a investor in these private companies, is that they want BlackRock in these investments because they know we're long-term holders. And so I think that is just a critical element of the sourcing of these private investments. But in terms of managing that liquidity profile, I would just reiterate that it is only up to 25%, and we do have some internal mechanisms built in to make sure that we have ample liquidity as we approach that liquidity event in year 12. And so that would be considering the life of the investments, and making sure that we don't have any type of tail risk beyond that year 12. There is also language built into the prospectus that allows us to extend the life of the trust if it was necessary. I would note that at least in BlackRock's case, we've never had to use that, but it is a backstop in the case that you are in an inopportune time. You don't want to simply liquidate just to get liquidity and have a bad execution for shareholders. So we do reserve the right to extend the life of the fund, with board approval if necessary.
Thank you for that, Stephen. I think we have about 5 or 10 minutes left, so I think maybe what we'll do is turn to a little bit of crystal balling for what each of you may expect to see coming down the pike here. So maybe we'll start, same question for each of our 3 panelists. We'll kick off Finbar with you. But what are you really expecting to see in the closed-end fund market over the short and medium term?
So we started off the call, I guess, Jeff, we talked about how the term has moved from a 5 to 7 to 12 year. And in addition to that, how it's no longer a client-paid sales load, it's an issuer-paid load. And what we've seen as a result of that is, I'll go back to my original statement about the increase in our user base amongst our financial advisors here at Morgan Stanley. And the proof, of course, is in the numbers. So in the short term, I don't expect there to be, much appetite to go beyond that 12-year term structure. I think we have conditioned the market for that. Advisors have come to accept that, and they seem comfortable with it. There may be some extension in the medium to long term, but for now, as I said, I think the market is conditioned for that. Where I do see, some scope for creativity, if you will, and product expansion, is the fact that given that the advisor base has increased, now there are more eyes on these new issues. So I expect issuers such as my fellow panelists here to have their boots on the ground, reach out to advisors and see where the appetite is for exposure to themes or sectors within this new structure. So going forward, in the short term at least, I expect to see a continued diverse and differentiated product set.
So Dave, maybe same question to you.
Well, as I mentioned earlier, I've witnessed this for a little over 30 years now. In the days of bringing your third, fourth, fifth state muni fund, I think certainly those days are over. Finbar mentioned, and Stephen has touched upon this as well. I think we'll continue to see, differentiated products that provide access plays to various asset classes. I think the structure itself will continue. I think it allows an investment manager to take a longer term view of what they're investing in and let those themes play out, which is, perfect for something, as Stephen has mentioned, private sleeves. I think we'll continue to see the types of investments evolve. Alternatives, I think, are clearly primed for being in a structure that doesn't have to stand ready to redeem assets on a daily basis. So ESG, we've seen a couple deals that will continue to see products that have that tilt as well. It ultimately comes down to delivering what the advisor and client wants. And I think it's clear by the capital being raised this year that having differentiated access plays is attracting meaningful assets into closed-end funds. And from our investment managers' perspective, I mean, they love managing assets in a closed-end fund wrapper. It allows them to deliver over time excess returns, excess income. You can deliver more. Again, you don't have to have the liquid assets sitting there to redeem shares on a daily basis. So I think we'll continue to see those themes. And I think, Stephen, I might have stepped in front of you on a few comments because I'm guessing that's what you're seeing as well.
Yeah,
Stephen, fire away. I don't want to step in your way either, so I'm gonna get out of the way.
No, I would agree with everything that Dave and Finbar have already highlighted. I think definitely the 12-year term structure is something that we've kind of circled around, and like I said, every single one of our funds that have been launched since 2019, we've done 5 of them, all of that the 12-year term. I think that makes sense, both from an investment landscape perspective, right? I think you need a long enough period of time, especially if you're going into these private markets, where you can let that strategy play out. You also need time to recoup those upfront fees that David highlighted. So I think it needs to make economic sense to the manager as well, to keep new products coming in this market. But when it comes to the types of strategies that we're thinking about launching, I think we also are considerate of the market environment, right? I mean, if you look at where yields are today in munis and most credit assets, it's very difficult to launch a fund that pays a competitive yield with something in the secondary market that has those legacy bonds that have higher book yields or trades at a discount, so just naturally has a higher yield. And so those are some things that you need to consider when you're bringing a new product to market. We've primarily focused in the equity space, which it has been a bit of a differentiator for us. But also I would highlight some of the comments that Dave made around the increasing investor base, in particular, the types of clients, not just the advisors, but the types of clients that are investing in these products tend to be higher net worth. We're seeing, not only more advisors, just, throwing out a couple stats in the, in the old, what I would consider traditional closed-end fund IPO structure, we were reaching about 1,500 advisors. In the 2.0 structure, we've reached about 7,000 advisors. So grown exponentially in terms of the buyer base. But we're also talking to larger producers. Just another stat here, in our offering earlier this year, sales from advisors with over $500 million in assets under management, where it was 381 million in that deal. Versus our first deal in this new structure, which was 71 million. So over a 400% increase from those types of advisors, and also much larger ticket sizes. The average ticket size in the old structure was about 40,000. Today, we're seeing it about 70,000. So, not only more advisors, higher net worth clients, and also I think that's going to pan out well in the secondary market because, the more people that are interested in the space creates more demand, better trading dynamics in that secondary market.
No, thank you, gentlemen, for the insight. I think we had a couple of questions that actually came through, and so I think maybe the first, Stephen, I'll go to you just because I think it's based on the size of some of your raises. This is going to be in your wheelhouse, but I think as we ran through the kind of the raise that we've seen here in 2021, somebody rightfully pointed out there's a lot of billions in those numbers, and so. Is bigger necessarily better? And I guess the question, maybe put a finer point on it, Stephen, is how are you thinking about it from an investment perspective? When you're having to invest, $4.5 billion from a closed-end fund versus, what could be a $500 million raise. I assume there's different aspects to be considered in that. So how do you kind of manage all of that?
Yeah, I think it depends on the strategy there in terms of the capital that we can raise in any one fund. The fund that you're referencing, Big Z, which is a $5 billion raise, is investing in public equities. It has that private component to it, but ample liquidity in the types of companies that we're investing in on the public side. And to my, I would make the point that the more capital that you raise, the better sourcing and opportunities you get in the private markets as well. So I do think size is better in this, in closed-end funds, not just from an investment perspective, but also in terms of, secondary market liquidity. Larger funds, with larger market caps are going to trade more during the day. Again, allowing more types of investors to invest in these types of products, not just individual retail investors, but also institutions. And then, you also have lower expenses, for the end investor as well. So I do think size is better, and you're definitely seeing that, outside of the IPO market. Look at what's happening, to existing funds with all the mergers that are happening in the closed-end fund market, only producing, I think a better landscape for investors.
It makes absolute sense. So one of the things Dave, I think, pointed out earlier was the size of some of these checks that sponsors are having to write. And obviously they're somewhat staggering depending on the size of the deal. So the question that came in is, how do managers that don't have the resources of a BlackRock, for example, how are they thinking about paying for these upfront fees? And maybe Finbar, maybe we can come to you on that, being that you see a kind of a wide universe of managers. What are some of the discussions that you're having with managers as they're thinking about having to write these kind of large checks up front?
So I guess for some of them, it's it's a bigger upfront cost to incur than it is for for the other large asset manager that you mentioned. And in general, while that may be the view, Jeff, I think that managers see the overall benefit of managing a 12-year term structure, and at some stage, they will break even on the revenue generated from managing those assets. It has never come up in conversation, right? That some managers may have to, find alternative resources to pay the upfront fees. I think the issuers that have come to market since January 2019 have the resources to do so. Again, while for some it may be a bigger burden to incur upfront than for others, I think overall the benefit of the 12-year term structure is that at some point in time, the issuer and or the fund manager will begin to generate enough returns to repay those expenses.
No, thank you. And I think we have come to the end of our session. So Nicholas, with that, I'll turn it back over to you.
Well, all I would like to say is a big thank you. This was a very interesting discussion. You covered a key topic for the industry. And again, thank you to all of you for your participation and support. We couldn't have done it without you. Thank you very much.
Thank you.
Thank you, everyone.
And I know that next year, Jeffrey, as you mentioned, we all hope to be in person.
Absolutely.
Thank you.
Thanks, everyone.